Welcome back, everyone, to The Road to Financial Freedom, a podcast that allows experts to share their stories and secrets to unlocking their financial independence. This podcast is brought to you by CamaPlan, a self-directed IRA administrator in Ambler, Pennsylvania that is focused on educating investors with different ways to grow their retirement savings faster through alternative investments. And today, again, we're recording this episode remotely. I'm Jess Jones. I'm a CamaPlan team member and podcast host. This week, we're going to take an in-depth look at one stop along many of our roads to financial freedom, tax laws. So 2020 has been a confusing year on so many levels. In their efforts to help businesses and taxpayers cope with economic disruptions, Congress and the IRS have passed a veritable blizzard of new rules and deadline changes, many of them affecting retirement savings. Some of the new rules leave certain issues vague or unaddressed, deliberately so in some cases in order to get these approved or legislations passed, with an understanding that these issues will be resolved later. But don't feel bad. Even the pros are bewildered by some of this. So that's why we're sitting down with Carl Fischer, co-founder of CamaPlan and one of the nation's leading experts on IRA and 401k investing, to sort out some of the biggest changes. So thanks for joining us today, Carl.
Hey, Jess, thank you for asking me. I think this is probably a very timely time to have this discussion because there is a lot of things changing and people don't know where we are right now. And we're basically in the middle of the pandemic. I think we said month 4. It's the middle of July, and Congress is up there making new laws as well as modifying some of these as we're discussing now. So always talk to your professional advisor, accountant, tax attorney, etc. whenever you're making these types of decisions. We're going to try to give you some guidelines for planning now, but before you're filling out your forms, etc., make sure you understand what things have changed and which things have stayed the same.
Great. Thanks, Carl. So I know I have a lot of questions as a novice to tax law. So let's get started. Can you tell me some more about the changes to required minimum distributions, or what we'll probably call a lot during this podcast, RMDs?
Sure. The long and short of it is RMDs, required minimum distributions, are suspended for 2020 for everybody, basically, whether it's in an IRA, a 403B, a 457, a 401k, and that's basically due to the virus and the hard times and financial difficulties that people have endured from being out of work and basically been locked up in their homes. Some of you remember the government did this in 2009 during the Great Recession. Plus, the RMD age has been changed from 70 and a half to 72 before all of this started. So there's a whole combination of RMD changes that are out there. So definitely pay attention to it if you're in your 70s. So what does it really mean? No matter what, nobody has to take an RMD this year. They've just basically been wiped out. The 2020 suspension includes participants who delayed their first-time RMDs for tax year 2019 until April 20th of 2020 and had not received a distribution before January. After 2020, you start taking it the year you turn 72. So just keep that in mind. If you're 70 and a half this year, you don't have to take a RMD. If you're 72 this year, you don't have to take an RMD. And for those of you who were taking RMDs in the past, in 2021, if you're 72 years old, you need to take one. If you're not 72 years old in 2021, then you don't have to take one. Some people have asked, if you don't take one in 2020, do I have to take 2 in 2021? And the answer is no, you do not. Everything has been suspended, as we said earlier, for 2020. If you took an RMD before the pandemic hit, like in January or February, before they made these concessions, you can roll that back in to your custodian up until August 31st of this year. So if you don't want that money and you want to put it back and you don't need it, you have until August 31st to do that. If you would have taken a 2020 RMD, right, this is my favorite because, Jess, as you know, and many of our listeners know, I'm a
Mhm.
pro Roth IRA 401k fan. And if you were supposed to take an RMD and you haven't been financially harmed by this pandemic, it might be worthwhile to take that RMD and convert it to the Roth and pay the taxes on it this year. That's one of my favorite things. So think about converting whatever your RMD would have been to a Roth.
Yeah. So that's interesting. So it does bring up a couple of questions for me. Probably the most basic one is what distinguishes an RMD from just a regular distribution? Why is it considered required?
Well, what happens is basically when someone is your age, Jess, in their 20s, the government says if you start saving for your retirement, we're not going to charge you taxes on that. And you can do that all the way from your age now until you reach 72. It used to be 70 and a half, but I told you it changed to 72. But once
Mhm.
you reach 72, basically, 50 years from now for you, you have to start taking distributions because the government needs you to start paying taxes on what you made. So let's say you put $6,000 in there for the next 50 years, and it was, would have been $300,000 worth of income, and you turn that in, I mean, not income, but $300,000 worth of contributions. But now, because of your investments, it's $3 million. So it's 70 and a half or 72 now. You would have to start taking that money out of a traditional IRA or a 401k or a 403b, all of those qualified plans, except for a Roth IRA. If you have it in a Roth IRA, you are not required to take distributions. And people say, well, why not? And the answer is because the government doesn't care about them because you're not getting taxed on that money. So
Okay.
at 70 and a half, the government says you've used your money and our
Uh-huh.
money long enough. Start taking it out so we can start taking taxes.
Got it. Okay. So then again, it would be another good reason to start looking into a Roth then. So that way, you're holding on to more of what you are making then. And especially if I'm going to start investing now in my 20s.
Yeah, sure. I mean, think about it. Would you rather pay the tax on the seeds or the crops? And like
Right.
I said, if you put 6,000 in for 50 years, and paid the taxes a little bit every year, that $3 million would now be tax free to you if you
Right.
put it in a Roth. So yeah, you're 100% right. You're looking really smart, Jess.
Thanks. Yeah. I just definitely something that I do want to consider. So in terms of the different types of accounts and how RMDs are determined, how exactly is that calculated? I know that an RMD calculator exists. I'm just not entirely sure, what are the two factors that go into that equation, or what factors compute your RMD. So, and I'm just curious, does it differ for different types of accounts? So, I know you mentioned traditional accounts, you do have to start taking that RMD when you turn 72 if it's after 2020. So, what exactly is the math on calculating an RMD?
Well, there's a couple different ways, but most calculators are set up this way. You ask what determines the factor, and the determining factors are your age and the amount of your account on 12/31 of the year before. So let's say in 2021, December of 2021, your account was $3 million. You turned 72, you would divide $3 million by 30, because if you look at the government's table of RMDs, when you're 72, you divide it by, I'm going to take this number, it's around 30. Every year older you get, that number decreases. So let's say at 70 it's 30, at 115 it's 2. So if you were 115 and you had $3 million, you'd have to take out $1.5 million. If you divide it by 30, then you're taking out 100,000, and that would be your RMD if you were 72.
Okay. So that makes a little bit more sense to me. Thank you. So you said now I'm turning 26 in December of 2020. So I don't need to worry at all about an RMD right now, right?
No, you're way too young. Required minimum distribution for that. The only time that it would really matter would be if you inherited an IRA.
Right. Okay. And I think we'll touch on that a little bit later. But if I had turned, say, 70 and a half, and it was still like December, my birthday's in the teens in December. So I turned 70 and a half this calendar year in 2020. Could you just go over again, like how I'd be affected by that?
Well, if you turn 70 and a half in December, you wouldn't have to pay anything. Remember
Right.
all of these things, but you're not even going to be 70 and a half in
Right.
2020. You wouldn't be 70 and a half until 2021, but by the time 2021 comes around, you'd have to be 72. So you're not going to have to pay anything until 2022 when you turn 72. Or if you turn 72 in December of this year, you would have to pay next year in 2021.
Got it. Okay. Thanks. So, how does the 2020 suspension on participants that you mentioned who took their first time RMDs in 2019, anytime between January and April, how does it exactly affect those participants? Are their RMDs being waived entirely then for the 2019 tax year and their first time in 2020? Or what are the like, it basically what happens to those participants? What options do they have? And then what about those who had to take their first time RMD, say, like, April 21st and on, when things were still kind of up in the air during COVID and countries or states, I'm sorry, weren't shutting back down? I'm just kind of curious if you have any input on that.
In 2019, let's say you turned 70 and a half in 2019 and you took your RMD in 2019 and it's in 2019 tax year, basically before 12/31. That's done. Your RMD is done. You can't get it back. But the first year you have to take an RMD when you turn 70 and a half, you had until April of the next year to take it. If you hadn't taken that, then you don't have to take it. If you have taken it in 2020, then you can give it back up until August 31st of 2020 and not have to pay taxes on it.
So anybody then who basically all RMDs, like you said, are being waived for the year of 2020. So even if someone had to take their RMD after that April 20th date, they would still be able to say, no, I'm waiving it this year due to, the pandemic or whatever.
Exactly.
Okay.
Absolutely.
Yeah, that definitely clarifies it for me. Thanks. So the last question I have surrounding RMDs would be what qualifies an RMD for that return? And I know we were discussing before we hopped on and started recording the exception to the 60-day rollover rule. If you're able to talk a little bit more about that and what qualifies an RMD for return, I think that'll also help clarify things for myself and for our listeners.
Well, basically, the IRS and Congress are still working some of these things up. But if you have to take an RMD in 2020, you can't. Obviously, if you have COVID or any of those things, it's easy too, but it's all been waived. So basically, the 60-day rollover, in my mind, if you took one out and you qualified as a COVID distribution opposed to a 60-day rollover, then you can go out to 3 years. If you took it out and didn't qualify it as a COVID and can't get it marked as a COVID, then you need to put it back within those 60 days or definitely by August 31st for this year.
Got it. Okay.
But again, let's keep an eye on that because Congress is talking about coming out with something again here in the next couple of weeks.
Right. Things keep changing. And I think that, keeping a figure on the pulse is probably the most important thing a lot of people can do right now for sure. So thanks for the clarity on all that.
But we've worked with PenServe too, right? And let me go through a couple examples that they've worked with us. for the late rollovers, right? And example one, the participant received their 2020 RMD on February 20th. They now know that the RMD is waived. It is within 60 days, so rolling it back is certainly okay if they were in that.
Right. That one seems really straightforward.
Same example, except they received the RMD on January 2nd, but at that point, the 60 days would have passed, but they would have 3 years to roll it back if they can get it as a COVID distribution. And I think they're being very lenient on that.
Right. And I know a lot of things are being outlined about, what qualifies as you've been affected either economically or, health wise, obviously. Great. Well, thank you. Thanks a lot again for, clarifying a lot of this stuff. I already feel like I know a little bit more, so I appreciate it. So moving on to contributions, what can you tell us about the changes that have surrounded contributions in terms of all the recent tax law changes?
Think about it. You can now contribute or continue contributing to IRAs, 401ks, and most qualified plans as long as you have earned income for the tax year which you want to make the contribution for. This means that if you're 72, you can take RMDs from your account as well as making contributions to your account, whether that be an IRA or a 401k in the same exact year. And there's no penalties, et cetera, associated with any of that. Remember, you'll be required to take your distribution anyway, beginning the year you turn 72, whether you make a contribution or not.
Great. So it sounds like this is a change that really benefits all parties involved. So you could have a traditional account, Roth account, it doesn't really matter. It's now at any point you're not capped at what you can contribute as long as you're earning income for the year.
Exactly. And it's
Got
more
it.
of a legacy play, for your kids and grandkids if you're, well to do at that point in time.
Got it. Okay. So that's helpful. This does bring up some more questions on my end. So, how exactly, even before all these changes, how does a contribution limit get determined? Do you know how are different IRA accounts affected by these limits? Do they differ depending on what the account is? And are there any specific reasons why?
Yeah, that's a pretty great question with a lot of answers. But yes, almost all of the accounts have limits as to how much you can put into them. There's business accounts such as SEP and simple IRAs. There's personal accounts such as the traditional and Roth IRAs, spousal IRAs, and custodial IRAs, possibly for your children. And most of those are limited by, right now, this year, $6,000. If you're over 50, you get to put another $1,000 in it. Those change every year based on cost of living adjustments and Congress's rules. And they started out, back when I was, back in the 70s at 2,000, and now they're up to 6,000 and 6,500 in some cases for the personal ones. And the business ones, the SEP and simples, are in the teens, early 20s, depending on your age. The SEP is in the 50 to 60,000 range that you can put away. So the limits are set by Congress. 401ks are basically 60,000 as well, and thereabouts. There's some defined limit, defined contribution, or defined benefits plans that you can put more money into. I think up to a couple 100,000. So these limits are out there, and you just have to look at how much you make, because there's also income limitations. So if you make too much money, they won't give you a deduction for a traditional, or you make too much money, they won't allow you to make a contribution to a Roth.
Got it. Okay. So you touched on this before when you were explaining the changes to contribution. So before any changes happened to tax law, participants were unable to take an RMD from and contribute to an IRA in the same year.
Correct.
Got it.
Yeah, if they were 70 and a half, they could not make a contribution. anymore to their
Right.
traditional IRAs. To the Roth, they could, but to the traditional or the 401ks, they couldn't.
Great. Okay. Well, thanks. So I'm curious, and this is even again a question that can date back to before any of these changes happened in 2020. What happens if you stop earning income in like the middle of a tax year? So, for example, someone loses their job or retires in May or quits in November prior to the next year's contribution deadline or prior to the tax year's contribution deadline, but still technically worked in that year. Are they, that's still earned income. So are they still able to contribute to their IRA?
The simple answer to that is yes. As long as you have earned income, you can contribute up to $6,000 to your personal account. Or let's say you only made $3,000 that year, then you could contribute the $3,000. So it really doesn't matter as long as you've got earned income, a W 2 or a 1099, and your AGI on your tax return got a positive value there, then you can make a contribution.
Great. Okay. So, a question that I do have then relates to COVID-19 and how it's affected contributions. So, I know change in income is something that has affected a lot of people or people who have been furloughed or had to start working part-time or things like that. Is there is there a correlation then, just to clarify for myself, between how much you're earning in a year and how much you're allowed to contribute? And have you heard anything about COVID affecting that, or it's really just you've earned income and it's determined then what you're allowed to contribute based on what you earn? I think that's where I'm just confused is what.
It's let's just make it simple. If you earn anything in the tax year, then you're able to contribute to the IRA. So if you earn anything between January 1st and December 31st, you'll be able to make a contribution for that year. And the amount of that contribution will be, in the traditional or the Roth IRA, will be either the max of what you made or $6,000, whichever is less. If you made $15,000, you'd be able to put $6,000 in your IRA. If you made $6,000 in that year, you'd be able to put $6,000 in your IRA. If you made $3,000 that year, you'd be able to put $3,000 in your IRA.
Got it. Okay. Thank you. That helps. That clarifies it for me for sure. Cause I think I wasn't sure. Cause I know, like, hypothetically, if I open an IRA, start contributing to it now at the age of 25, and I fill my contribution limit for the following tax year, but then I retire at 75. And even though there's no more contribution limit or a contribution age where I'm cut off from contributing, if I don't have earned income, I'm technically not able to contribute to my IRA, even though you mentioned it's a legacy thing, but I'm just curious about how that works, like after retirement, if there's no more cap on what age you're allowed to stop contributing to.
Yeah, if you don't have earned income, you're not going to be able to contribute. But you do see a lot of people taking jobs after their retirement. They may do consulting. I've seen some people pick up musical instruments and become a band. I've seen others go and do plays, and they get paid for these things, and they pay taxes on it. Therefore, they could do it. There's a lot of people your age that aren't allowed out at the bars and restaurants because of COVID. So they're saying they're saving up money. And they've seen that if you start saving at 25, then you can, it helps you down the road because of the compound interest. And you have those extra 10 years for the money to compound. So I do see a lot of that happening now because people aren't going out and spending the money that they are making. They're basically, in their homes and, buying food and maybe a couple of things on Amazon, but they're definitely saving money at this point in time.
Yeah, definitely. I know, my heart hurt a little bit when you mentioned, that I'm not allowed out to eat or go to the bars anymore. It's true. But I am saving some more money, so I think that it is something people my age should potentially start to look at. You can use that money and start putting it toward your future so that when I am 75 and I'm retired and I want to be in Macbeth, I can make money doing that.
Yeah, and maybe if you start saving now, maybe you're done at 50 and you have enough to live, and you just
Right.
say I'm retiring now, and then you go play Macbeth.
So, a lot of the changes that are happening to early distributions and other distributions, can you go over some of those? Like, I know birth and adoptions and medical expenses, disaster distributions, those are all things that are being considered now to be under the changes to tax law. So, I think there's some information that you're able to offer about those if you can.
Yeah, yeah. There's several of them. Okay, and if you have a birth or an adoption, there's no withdrawal penalty for early distributions within the first year of the adoption or birth. So some 2019 births and adoptions are eligible. Maximum withdrawal is 5,000 per taxpayer per birth or adoption, and you're going to be paying a lot more than that with having a kid, whether it's adopted or born.
Right.
And repayment is permitted with no deadline when you take out that distribution. So they are modifying some of the rules. They didn't used to allow all of that. Medical expenses have gone from the 10% level to 7.5% level. So if you made, let's say, $100,000, because it's easy to do the math, if you had $10,000 in expenses, then you'd be able to qualify for the exception. Now they've lowered that to 7,500.
Okay.
So, and it covers, all years prior to 2021. So there may be some savings to you by amending the returns for prior years that haven't already expired. And they've always had, I shouldn't say always, but when there's certain disasters out there, the government has let you do it. I live in Florida, and we have a lot of hurricanes
Right.
and Sandy up in the Northeast, and the earthquakes out in California, and the tornadoes in the Midwest, etc. Any of these disasters that FEMA gets involved in, they usually will come up and make an area and a time frame where distributions could be taken, penalty free. From 50,000, it's gone up to 100,000. Just like for COVID-19,
Hmm.
you're allowed to take out the 100,000, pay it back over 3 years, or take it out and not pay it back and just pay the tax over 3 years. So it really is a help to families that run into hardships based on these types of situations. And obviously, some of our clients have had that happen. Some people have had heart attacks, and surgeries before COVID, and then haven't been able to go back to work. So there's a lot of those types of things that are out there, and that the people need to make themselves aware of if they do have these plans, because they are penalty free. If you're, as an example, if you're not 59 and a half and you take money out of your IRA, you're going to pay 10% penalty on that. So if you took out 100,000 right off the bat, you'd be paying $10,000 in penalty plus your taxes on that 100,000. Does that make sense?
It does, yeah. It's starting to come to me a little bit more easily now, but I definitely have some follow-up questions just based on, what you're saying and what we've gone over even before recording. So, with birth and adoption early distributions, they're only for 2020 and beyond. I know there are some 2019 births and adoptions that are still eligible, but I'm just curious about, when the IRS or Congress is saying that this rule is officially enacted, or the cutoff date or the starting date that this is allowed.
Well, my understanding, and again, we should caveat this with, and nobody's done it, but it's started in 2020. But they said that if you want to go back and amend your taxes, and I believe they're saying 3 years from 2020, so 20 up back to 2017, you can amend your taxes and get this credit. But the question is did you take the money out at that point in time, and can you take it out now based on that? And I'm not sure of that answer, quite frankly.
Yeah, definitely. I'm ways away out before I even have to worry too much about it for 2020. I was just thinking about it. I was like, if I had a kid December of 2019, like how would that have been affected? But yeah, I think we can definitely get the answer on it. And
Yeah, if you had a child in December of 2019, I think yes, you can take the 5,000 out of it at that point in time.
right.
And
Okay.
so, I mean, we'll have to get back and just look at those specifically.
Yeah. And do you know if kind of similarly to how you were saying with required minimum distributions and how the government's been, looking at people's individual situations and how they've been individually affected by COVID, are some of these still kind of as Congress and the IRS are figuring it out, sort of on a conditional case by case basis?
Yeah, I mean, basically everything with the IRS, is a case by case basis. I mean, they put the rules out there, and that's why I think we have to have CPAs involved in where we are with
Right.
those points. I mean, if you don't have an IRA or 401k, and there's 401k rules that are there too. But basically, it's taking the money out without penalty is what we're looking at because of circumstances that are
Right.
there. And even though I say it's a case by case look, I should say, when the hurricane hits, southeast Florida, northwest Florida doesn't necessarily get the break.
Right.
So it is regional, it is individual, but there are some general guidelines, I should say.
Got it. Okay. Yeah, that helps clarify it a little bit more for myself. And I think, a lot of listeners will be able to hear that and understand. I think the importance, especially just overall with all of these rules, of having a team of trusted professionals on your side too, especially, if you're someone who's not in this business and or industry. I think, just trusting your financial advisors and your tax advisors and tax professionals is going to be really important, especially this year.
Yes, absolutely.
So one question I do have, it's the rule for the for births and adoptions is maximum withdrawal of 5,000 per taxpayer per birth or adoption. So say like triplets are born, there are two parents, it's just $5,000 max per parent's account. Or say if it's twins, it's probably more straightforward. I feel like triplets would probably be kind of like what we were saying, a situation where the guidelines would be a little different. Your situation would be different. You should consult a professional. But it's two children are born, or a child's born in the same year someone is another child adopted by the same family. It's only one parent's $5,000 per their IRA.
I don't believe that's the case. I believe that you could take 5,000. If both parents had them, you could, and you had twins. I think you could take 5,000 from each because they do say per birth per family.
Got it. Okay.
So I do think we're able to do both of them. I hope I'm not wrong on that.
Yeah, that's one I think we can definitely also take another look at too. But it's something that, came up for myself as I was trying to think of like, these are questions. I think a lot of my questions as I was learning about this myself before we were recording are kind of very conditional. So,
Yeah. Well, yeah. I mean, my brother and his wife adopted two children. A brother and a sister in the same year.
mhm.
And I'm going back to that. The amount was less, but they were able to take credit for both of them.
Got it. Okay. So with medical expenses, I'm just having a little bit of trouble understanding, the language that was provided to us about like what exactly can be covered for a distribution for a medical expense. So what qualifies and how do you amend all the years prior to 2021 to cover expenses under new tax rules? And I know enough about HSAs, but I'm also kind of curious about, is an HSA affected at all by this, or is it just kind of like any IRA?
It's basically any IRA. If you have medical expenses, and let's use our example that we talked about earlier. Let's say in 2018, or 2019, you had $10,000 worth of medical expenses and you made 100,000. Nothing would be allowed. But now they drop it to 7.5. So if you had $10,000 worth of medical expenses, 2,500 of them would be eligible. And and you ask what types of medical expenses. There's publication, I think it's 969, and they're pretty lenient on what medical expenses are. Obviously, doctors, hospitalizations, they're not going to allow cosmetic surgery, but anything that's necessarily done. And I think they even count dental work and eyeglasses in that as well.
Okay, great. No, thank you for that. That helps.
Does that help?
Yeah, for sure. It makes a lot more sense when you break it down like that and kind of simplify it to real numbers and real examples. So this is really helpful. An example that came up for me is like if let's go back to the hurricane example, or if my home was hit by a tornado or was damaged from a hurricane in the summer of 2020, if FEMA was involved, then it would qualify for an early disaster distribution, even if it happened after that, March 19th date.
Yes. I mean,
Okay.
at this point, if they declared a disaster, a natural disaster, a federal disaster, then you're going to be able to take an early distribution.
Got it. Okay. That's a fun fact. It's one of my biggest fears that a tornado is going to hit my house while I'm asleep. It's like a dream that I have a lot. It's a fever dream of mine. It's like my recurring fear dream. So,
well, you guys had a pretty good nor'easter up there where it took down trees and took power out of the office there for a couple of days.
Yeah, it was bad. There are
right?
trees that are still snapped in half, like giant trees in my neighborhood. So, we lucked out at my house, but there are people that a couple of houses in my neighborhood did actually get damaged by trees falling down. So it is, I think something like that could be considered a disaster, or, you can take a distribution out then for something like that. I'm wondering if, in general too, like if like a tree fell on your house, does that count as a disaster, or is that something that's more like insurance based?
That's more insurance based, and
Got it.
it's too localized. I
Right.
mean, the chances of a tornado just coming down and hitting your house, Jess, is probably pretty slim. But if it took out Montgomery and Delaware County where you live, it would be I'm sure that would qualify.
Right, like it would be a disaster on a much larger scale if it was a
Right,
couple times.
FEMA would come in, Red Cross, everybody would be coming in trying to help out.
Right, got it. Okay, that helped clear it up on basically, what is qualified as a disaster versus what's a specific incident or damage that happens on a home. So there are other distribution rule changes as well, right? So what do some of those look like for, I know we talked about earlier, you mentioned beneficiaries and things like that.
So beneficiaries of IRA account owners has been accelerated for the most part. Anybody who passes, January 1st on of 2020, basically you have 10 years to use the money in the IRA or take it out at the end of the 10 years. Before, you were able to do it based on the lifetime of the beneficiary. Like I could leave my IRA to my grandchildren and they could use it for 60 or 70 years. But that has passed, and they moved it to you have 10 years max. And that's whether it's a Roth, a traditional, any type of those that are out there. Anybody who died before 2019, they can use it for their lifetime. So there'll be people that, died and gave it to their grandkids, and they'll be using it for, 30, 40 years. But any of my beneficiaries will only get it for 10 years. So
Got it. Okay.
let's talk about how these people are affected, right? Once they withdraw the money within the 10 years, 2020 will not be part of the 10-year countdown, so it will be 2030 when they're going to take out their last amount of money. If no RMDs were taken prior to the death of the account holder, the surviving spouse can wait until turning 71, actually 72, before taking the distributions. Minor children can wait until they reach majority age before taking distributions. So if I did leave it to my grandkids until they're 18, maybe 21, depending where they live, they could start taking the distributions at that point in time. If you're disabled or chronically ill, you're excluded from the minimum, and beneficiaries less than 10 years younger than the deceased are also excluded. So, if my wife was 10 years younger than I was, then she could be excluded. That's not the case, though.
And by excluded, Carl, you mean that they would be excluded from the 10-year rule and they would be able to use the lifetime rule, or?
Yes. That's if it was a spouse. Sorry about that. But beneficiaries less than the 10 years younger than the deceased are excluded from the above. But no, if the beneficiaries, no matter what age the beneficiaries are, if it's after December 31st, 2019, then they've got 10 years. And non-spousal beneficiaries, charities or estates, they must take it within 5 years. But we should check on this again. All these things are still somewhat in flux. Some of them have been modified by COVID. In that point.
Yeah, no, I think that's really helpful. There are a couple of questions that I do have. I think you actually answered a lot of them, but so you said that it really depends if a child is the dependent, or I'm sorry, if a child is the beneficiary of a beneficiary. So a beneficiary inherits an account, they pass away, that person's beneficiary then inherits the account, but they're under the age of 10. How old is there an age that they have to be to wait until they start taking those distributions or have to start taking those distributions?
Well, if they're under 10 years old, they can wait until they are 18, depending, or 21 in that state before they have to take distributions.
Right. So in most states, as far as you know, is it 21?
It's 18.
Oh, 18. Got it. Okay.
In most states, yep.
Okay. So if I was a beneficiary to a non-spouse family member, like say I was my grandmother, she passed away when she was 70, around 70 and a half, like somewhere in that 70 and a half, 72-year range. But let's say she was 72, she passed away. She was my grandmother, but I was the beneficiary. My distributions then would look like, if she passed away in January of 2020, I would have to start taking distributions up until 2030, and that would be when I'd have to distribute the entirety of the account. Is that correct?
That is correct.
Okay. And would that start then? You said 2020 doesn't count. So does it start 2021, or is it 2021 to 2030, or is it?
It's 2021 to 2030,
Okay.
but you don't need to take a distribution necessarily every year, and it doesn't have to be a lot if you do have to do that, based on your age, because they haven't changed that part of it yet, and nobody knows how that's working, because that rule was there, and then COVID came and nobody's put it out yet. But by the end, you could take all of it the first year if you wanted, or you could take a portion, or you could divide it, equally among the 10 years. If you had 100,000, you could take 10,000 every year, but you got to remember that the money in there hopefully is earning something, in a piece of real estate or a note, or gold or silver or something, right?
Right. So when you say legacy before, a lot of people at this point, with some of the restrictions that have been lifted on making contributions and things like that, this would be an example of, it's a good thing to have an account that you're building a legacy for your grandchildren and your grandchildren then.
Yeah, I think that self-direction is great. It's a little bit like, if the grandfather or the father, they should teach it to their kids or their grandkids. And, they may not appreciate it right now, but they will as time goes on, and they understand what they've been taught, and how much money they've actually earned and saved from what their ancestors have set up for them. So yeah, I think it's good to, teach a man to fish instead of giving him a fish.
Yeah, definitely. I agree with that, especially as I've gotten older and, started to appreciate a little bit more of what my parents were trying to teach me as I was growing up, and I was like, "I just wanna sing." I think that it's definitely become more of a not an I don't wanna say issue because I think that's the wrong word, but more of a, something that's at the forefront of my mind now. So I appreciate, you taking the time to answer a lot of these questions that I have, especially because some of them are just so specific to, if I was X and this was Y, what's Z?
Yeah, yeah. One of the things too, you got to start talking a little bit about spouses, because spouses can still take their IRA from, let's say the surviving spouse can now transfer the deceased spouse's IRA directly into their IRA, which obviously would, make their IRA bigger, but it's also now based on their lifetime.
Right. So then a spouse then isn't subject to the same distribution rules because they have the ability to transfer the account to their own IRA?
Correct.
Okay.
Yeah, I mean, you can get let's say both people died and they were 70 years old. Let's just say the
Mhm.
man died first. The wife could inherit his IRA. Let's say they were equal. Her IRA would now be twice as much. But, when she turns 72, she's going to have to take an RMD, which,
Right.
remember when we talked in the beginning, it was how much is your account worth. Now it's going to be twice as much.
Mhm.
And you're going to divide it by, let's say, the factor 30, and that would give you your number. But if you live to be 80, now you spread that out over, 10 years. If you live to be 90, then you spread it out over 20 years. But let's say it goes 10 years or 15 years and you die at 85. Now, whoever inherits that, one of your children or grandchildren, they'll have 10 years to use it until they have to take it all out.
Great. Okay. I know we talked about the PenServe before and how we've worked with PenServe as well. They give an example of the 5-year rule for death distributions. Do you want to talk a little bit more about that?
Yeah, we can talk about it. So, if a beneficiary is subject to the 5-year rule for death distributions, the year 2020 has been waived for that. So, with your question before on that, do you get 11 years? We weren't sure, but on this one, you do get an extra year to do that. So, instead of
Hmm.
going from 2020 to 2024, you'll go from 20 to 25
Okay.
for that 5-year period. But there's nothing like that yet in the 10-year rule. But a lot of the accountants are saying that they're interpreting that to mean that, but it's not verified at this point in time.
Great. Well, thank you. Again, I really appreciate all the input and the knowledge that you've shared today because I think if anything, this is going to help a lot of our listeners, myself included, just understand how they can start to think about all of these tax changes and how it'll affect them either immediately or, in the future. And so I think, keeping a finger on the pulse, starting to be aware of, where people can look and what they can do in order to be as well informed as possible is a great first step. And I think listening to what you've had to say is going to be a great first step for a lot of listeners. So thanks again, Carl.
Yeah, no, I appreciate being here. I think it's important that people know that these changes are out there, even though they're not, completely substantiated and written down, basically because everything's in flux with the coronavirus. But yet you should know that they're out there and there is some relief for those people who really need it.
Great, thanks. And one final question before we sign off. How are people able to, you know, or reach out to any, resources or where can people go to look for more info about these changes?
Well, if you want to know the tax information, I would go to irs.gov/coronavirus to see the updates on there. And that's basically where I would start with. That seems to be some of the most up to date areas to look when Congress makes these changes. I keep hearing that the House passed this, the Senate passed that, but the president's going to veto this. So I don't know really where it is. We keep watching this, and these bills change as we go down the line. So just talk to your trusted financial advisor and go to irs.gov/coronavirus for updates, and don't listen too much to the news.
Great. That's a great sending off note. Thanks again, Carl. Tune in next week to hear more from experts who have paved their roads to financial freedom, or call CamaPlan today to learn more about how you can start to take control of your future wealth. Thanks, everyone, and have a nice week.